I'm going to try and keep this session to about half an hour if possible. Just give me 1 second.
Okay.
Because in the center, I use a Mac, a 27-inch, so obviously microphone positioning is slightly different.
Microphone is on the top of the screen. Is it much better now?
Yes.
Okay, good stuff. Are you able to see my screen?
Yeah.
Okay, good stuff. So I'm just going to run through, this is quite a lengthy presentation, about 30-odd slides. I'm going to send this to you along with the material which we have studied on the second unit, Finance for Managers, just after the session today. And I'll also send you some handouts which again will be useful for doing your assignment, and also will give you a bit more detail to these slides, with regards to the fiscal policy and the monetary policy. So here, I think the main objective today is we are looking at predominantly studying, let's put it this way, the environment in which the businesses operate. And the environment is actually controlled by a lot of government policies and laws and legislation. So we want to be able to study that and understand what is the effect of this, of these policies, the law and legislation on businesses in general. Wherever you're not able to understand, stop me there and ask me a question.
Okay.
So what we're looking at is basically studying some of these policies just from an overview point of view. We will look at how government does spending and how much and how do they borrow, and from where they borrow, how much they borrow, and things like that. Now, looking at the definition, what is fiscal policy? Fiscal, the word relates to finance. So fiscal policy basically involves the use of spending, which the government actually does. It also incorporates, the tax or the revenue it collects, from, users like us who are employed. And it also looks at encompassing the borrowing, which the central bank or the Bank of England actually does from the International Monetary Fund or, the European, bank. And that all constitutes, the fiscal policy. Now, fiscal policy has a far-reaching effect on the economic activity of any country in particular. And obviously, if it impacts the country, then, the economic activity of the country, consumers' buying behavior, the patterns in which spending happens, all that is affected. And in return, obviously, it does have an knock-on effect on businesses. Now, here, fiscal policy primarily relates to the, the growth and demand and supply essentially in the market. And how does it influence demand and supply in the market? So, for example, a good point here would be to look at if the interest rates are really low, that means it is cheaper to borrow money from the bank. And that means consumers have more money in their pocket, because in order to repay that capital which they are borrowing, the interest rates are quite low, which means that even if you take out a large loan, the amount of interest that you're actually paying back on that loan is nominal because of interest rates being low. The fiscal policy also kind of determines the supply. You must have seen that the reason why the Bank of England has actually kept the interest rate at record levels in terms of low for a number of years has been that it's trying to stimulate growth in the economy. And the growth can only happen if consumers have more money in their pocket, which means if consumers spend, then the businesses are able to look at the situation of demand and supply, and they are able to generate revenue, they are able to generate sales, and that then helps the government in turn collect taxes, which could be done in the form of collection of VAT, in particular when it is resold in the UK, but also in terms of import and export taxes or levies which they apply, in terms of products coming across from abroad or products being exported outside the UK into European Union and beyond. So why does the government tax? That brings us to the next question. The reason why the government taxes, as any household, if you look at, government also runs a business, is a kind of a business. If they do not receive money, if they do not have earnings, how can they do, for example, have expenses? So in order to earn revenue, the government has to charge tax. It has to look at ways and means through which it can raise this money. and that way and route of raising the money actually comes across from either levying taxes, looking at some of the instruments which they control, like for example the exchange rate in terms of currency. They look at, for example, the rate of inflation. They look at interest rates, and these are instruments which the government has to be able to kind of regulate the economy, environment, and in general, generate revenue. Now, you must have come across this term, which is called redistribution of, income and wealth. Now, the government's program are generally to look at, creating growth or creating jobs, in particular in areas wherein there is low income, families with low income, and also areas which, say, for example, deprived areas. Now, what the government does is, in those cases, it promotes businesses to open up factories or, offices in those locations, wherein it provides the businesses with some sort of short-term to long-term benefits. And they could be in terms of, things like rebate on tax, for example, rebate on exports or levies, which they apply on exports and imports and things like that. Now, in order for them to be able to look at, let's put it this way, creating or generating revenue, income for the government, they then look at a lot of other things in terms of taxes, which is direct and indirect taxes. So one of the mediums of looking at direct taxes is that when you earn a wage or a salary, you're taxed on it. So that's a direct form of tax. There are indirect form of taxes which the government also has. For example, if you're under 65 and you have TV in your house, obviously there is an indirect form of tax, which is you have to have a television license or a TV license to be able to watch TV. So there are several, ways available with the government to be able to create this system wherein they are able to generate revenue, as far as their income is concerned. Now, when we look at, the reasons why they look at tax and what are the kind of tax, I think some of the things that we will look at is things like there is direct tax, which I've explained, like income tax, for example, or VAT, which is levied on goods. Indirect taxes could be, your road tax, which you pay. Say, for example, the TV license that you pay. These are examples of indirect tax. There are progressive, regressive, and proportional taxes. Now, proportional taxes would be taxes which predominantly look at, for example, companies which do certain amount of turnover, or for example, when you earn income beyond 150,000, then there is a proportional or pro rata range of tax which is there, which is highest category is 45%. So if you're up to about 42,000, you're in 20% category. If you're between 42,000 and 150,000, you are at 40% tax category. And if you're beyond 150,000 in terms of income, yearly income or monthly income, then you are in a tax bracket of 45%. So these are some of the instruments or different types of taxes which the government applies in terms of generating revenues. Examples of direct taxation that we look at is direct tax. As I mentioned, it could be income tax, wealth tax. For example, if you sell a property or get an inheritance, there could be a wealth tax which could be put in. You could also have tax on your dividends if you buy and sell shares in the market, and if you get dividends from those shares or make profit from it, then there could be direct taxation on that. Bonuses, for example, when you receive within the organization. Direct taxes also include, national insurance and contributions, in particular, capital gain tax, anything wherein you've invested money. Say, for example, if you win a lottery, in some cases, I think there is a 10% tax on lottery wins. Corporation tax, if you run a business, then obviously businesses are subject to, depending on their turnover, corporation taxes. Now, direct taxation, in terms of the sentence here, it says the burden on direct tax cannot be shifted. That means if you earn something, if you earn an income or a salary or a wage, you have to pay that tax. That cannot be deferred. Now, over the last few decades, what has happened is we have really seen that once this tax structure was put in by the government, what we've really seen is that there are a lot of indirect taxes which have cropped up over the years. So, for example, things like television license, road tax. When you think of insurance, wherein you're paying a bit of tax. If you buy a house and if it's not a freehold, then you are paying for ground rent or things like that. Those are all forms of indirect taxation which have actually come up in the last 2 or 3 decades. Because from direct taxes, the government is only able to generate so much, income. So essentially, what you get to see is that over the years and in the last few decades, what has happened is the government has actually raised or created mediums through which they can create indirect taxation. Now, what is indirect taxation or indirect taxes? It's the levy which is applied on spending by consumers on goods and services. So an indirect tax, a good example of indirect tax is VAT. So when you fill up your car with fuel, you buy alcohol, you buy cigarettes, or you buy anything like car tax, they are all forms of indirect taxes. Excise duties on certain products, when you import them from abroad, even for personal use, these products have some sort of an indirect taxation on it because these products are either not freely allowed to be circulated or they are considered premium products in which there are duties. For example, leather products in particular, when you look at, or when you look at, say, for example, cars, there are some categories on which these indirect taxes do apply. One of the key categories, which is looking at cigarette, newspapers, and tobacco, CNT, any such raise in taxes on those, are basically indirect taxes. And I think every year you've seen that, the government always increases tax on alcohol or beer products, and the price keeps rising. So these are indirect taxes or indirect routes through which the government is able to raise money by levying a tax on a sale or a sale of a particular product or service. Now, what we also look at is that if you're earning, then you know that you're going to pay tax. But indirect taxes are mostly passed on to the consumer. That means the companies beyond a certain level will not be able to absorb those increase in prices, for example, because of inflation or because of the fall in the value of pound against the dollar. You must have seen heard in the news, I think a couple of weeks back, there was a bit of a tussle between Tesco and Unilever on the prices of certain of the products which are sold within Tesco supermarkets, like Marmite. So Tesco said, we will not be able to absorb these prices and we'll pass on the rising prices because of the falling value of pound against the dollar to the consumers. That led to a bit of a spate between the two companies. And because Tesco was able to kind of absorb that increase in price because of the increase in price of raw materials at Unilever end, that led to them passing the price increase to the customer. So Marmite, which was $2.79, actually became $3.29 in Tesco stores, and that led to a bit of a row. Were you aware of that 3, 4, 5 weeks back, I think?
Not that, no.
Okay, no worries.
No.
I think what we get to see in general after the Brexit is that you're seeing slight increases in prices of products which are being passed on to consumers when you go out and shop, do a local shop or a grocery shop. So you do get to see the milk, if it was 79p, it's become 85 or 89p. And you see small increases in prices which are being passed on, because on products which are actually coming in from EU, wherein the price of pound or the exchange rate of pound has fallen against the euro and the dollar, those prices are being either absorbed by the companies, and in some cases it is being passed on to the consumer. An example here would be when you look at the Mars bar, or the chocolate that is Snickers and Mars bar. So there was a news, I think, an article about 4 weeks back, wherein they said in order to look at combating the rise in the raw material prices, they've decreased the size of the chocolate bars. So that is a clear example of how indirect taxes in some cases, they are passed on to the consumer because the manufacturer is not able to absorb the increase in price, and then that directly affects the consumer, in this case when you buy products. Progressive tax, I've explained by an example of your income. So if your income increases, the rate of tax which the government actually levies on your income also increases. And that's a good example, or one of the best examples that you will look at when you look at progressive taxation. The other example that I would give you is if you buy a flat, and if you buy a house, and if you buy a detached house, and if you buy a bungalow, and you buy a mansion, the stamp duty on some of these houses when you buy actually keeps rising from 2.5% and goes up to as high as 10%. Have you noticed that?
Yeah.
Have you seen that basically? So this is indirect form of taxes, or progressive tax, which the government actually keeps applying on properties, or in areas wherein properties tend to vary in terms of their size, structure, and value. Regressive tax is when the tax rate actually falls, or what tends to happen is that the government has over the last few years has increased the minimum threshold. For example, when you look at from which your income is taxed. So at some point in time, I think in the 2006 and 7, just before the crisis, it was 6,400 which you earn was actually non-taxable. Now today that has gone up to 11,000. So the basic money or income that you earn, up to 11,000 pounds of that income is non-taxable, is tax-free. So this is an example of regressive tax, in a way that over the years the government has kept on increasing the minimum threshold at which you need to start to pay tax, and is an example of regressive tax. In UK, most examples of regressive tax actually come from excise duties or cuts in excise duties, which you do get to see on certain products. Say, for example, baby nappies or diapers do not have any tax on it. So at some stage, a couple of years back, maybe a decade or two back, some of these things had some sort of VAT or taxation applied on it. But now these products are absolutely, levies or tax-free. So this is a form of regressive tax, wherein the government has actually pulled back taxes on, some of these product categories. Proportional tax is is defined as the percentage rate of tax when it is constant. Now, you must have seen that in some cases, when businesses their turnovers go beyond, say, a certain threshold, they need to apply to get VAT registration. Now, that VAT registration in some cases for businesses which are services in general, like accountancy, legal firms, what they tend to do is they tend to go in for something called a proportion.
Hello. Hello.
Sorry, we had a bit of a lag there.
Okay.
What I was explaining was, the proportional tax. Now, one of the clear examples of looking at proportional tax is wherein what you'd basically look at is the income, the levels of earning of income that you earn, and the government tends to then apply a proportional tax on it. Going to something which is, talking about spending and expenditure. Now, what we are looking at is to understand how these policies and law and legislation, what we need to be able to do is understand what are the main areas in which there is spending and expenditure by the government. So can you think of a few areas wherein the government actually spends, and in areas wherein there is an expenditure in terms of spending from the government?
In the community,
Okay.
like roadworks,
Yep.
hospitals.
Excellent. Yeah. So spending areas, when you look at for the government, you rightly picked up things like NHS. You look at, obviously infrastructure or building works, as you have said, in roads and, infrastructure that they build. What else?
Schools.
Schools, yeah, education in general, defense, yeah. So when you look at, these are the areas in which, if you look at the UK GDP or the expenditure which the government actually does, UK economy, I think, turns over in terms of GDP is about 3.6 trillion. Now we are the fifth largest economy in the world. Now, when you look at the spending or the expenditure which the government does, they have certain key areas like education, you have NHS in particular, you have defense, you have schools and within the education, you also have infrastructure that they do spending on. And then when you look at other areas, social, justice, for example, you look at hospitals, you look at prisons, for example, and you look at people in terms of welfare. These are the areas in which the government will do normally spending. Now, let's look at why they have to spend. So, as an economy, for it to keep things running, the government has to then create employment and opportunity for people within the public sector to be able to offer these services on behalf of the government. So, most of the spending actually happens for creating provision of public goods or services. So NHS, for example, is a public, obviously a good example of public services which the government maintains and provides security in terms of defense spending. And when you look at welfare support, say for example, obviously we are a welfare state, but when we say we are a welfare state, that means the government will provide, food, shelter, and education for each and every citizen within the UK or citizen of UK. So from that perspective, these are the key areas in which actually government spends. Now, when we look at looking at this manifesto spending, you need to understand that if you're obviously from a perspective within the household, when you look at, you have a monthly income, and what you do is you drop a monthly budget for spending, correct?
Yes.
So if your incoming is say for example, let's say for example, say £1,000, then what you would do is you would basically budget how much is rent, how much is food, how much is other expenses, fuel, entertainment and things like that. So the government also will draw, and every business also will drop a budget for the financial year. That means in terms of how much they would spend in marketing, sales, business development, manufacturing, employee benefits or salaries and wages and things like that. So the concept of budget comes across as a spin out from when we look at government spending and expenditure. And that budget is passed within the Parliament every year. The Chancellor of the Exchequer will actually present a budget, and that budget then is passed obviously to then enact or take it through in terms of spending for the year. Now that particular cycle is termed as a business cycle or a financial year. So when you hear of words like, what is your financial year closing? So are you following a calendar year, which means Jan to December, or are you on a April to March kind of a calendar year in terms of your business cycle? So those are key terms that we look at when we look at government spending, budgets, and obviously business cycles. Now, quickly understanding key terms on this. What is a budget? It's a financial plan which the government actually kind of commits for future spending basis the revenue or the tax that it is going to accrue from the consumers in the country or in the economy. Similarly, a business will draw up a financial plan or a marketing plan which will have a financial component in it, and which will take into account the revenue, the sales it will generate, the revenue it will create, and what are the profits, or what is the probability of, and how much profit will it generate, and what is the probability of generating a profit in that financial year. That will constitute something called budget. Now, a budgetary control is a process in which you will apply financial control. That means within a business, you will normally have somebody like a manager finance, or if it's a large organization, you'll have a finance department which is headed by a chief financial officer, and that particular department will keep a tab on all the expenses of the business. So are you spending too much? Are the sales coming in? Is the revenue coming in on time? Is there too much of collectible from the market? Are we giving excessive credit to our consumers or existing customers? So all those things are are a part and parcel of something called budgetary control. And budgets basically refer to nothing but your income and expenditure, your income and revenue, and how it how managers within organizations, or how the Chancellor of the Exchequer is able to basically determine how close is he going to be in terms of his borrowing limits or in terms of his spending limits. So I think when we are closer to the month wherein budget is announced, what we tend to get to see and hear is that the Chancellor of the Exchequer is looking at borrowing 60 billion pounds for this particular term, or he's looking at borrowing in terms of say 90 billion pounds for this particular term. And then they talk about terms like, is there going to be a budget deficit, which means is he going to stay within his budget that he's prepared and within his purview of the spending that he's creating, or is there going to be some sort of a surplus, budget surplus? So it's a simple understanding analogy here, which I would give you will be that sometimes what you do is when you plan your monthly budget or monthly spending, what you will see is if I have a income of 1,000 pounds coming in, and if I'm able to spend 800, then I'm spending within my limit and I'm able to save 200 pounds. But in certain months, what you see is, okay, I've done some expenditure, my credit card bills are going to come next month. So my incoming is only 1,000 pounds, but I might be spending 1,200 pounds. So that is the concept of budget surplus or budget deficit. That means if you're overspending, then there's a deficit. If you're underspending and saving some money and living within your means, then it is called surplus. Is that understood?
Yes.
Okay, brilliant. Now, when we look at businesses in general, and when we look at things like economic growth or recession, these kind of terms, growth and recession, what you normally get to see is there is a cycle or a bell-shaped curve which every economy or every business follows. So if your hit product, like the Apple iPhone, which is making the company revenue grow over the years, but now it is beginning to taper off because a lot of market and other competitors in the market have actually caught on with Apple, and they are very similar, or if not better products than Apple available in the market wherein consumers are willing to buy. So now they are on the lookout of coming out with a new hit product. And if you imagine a bell-shaped curve, that say for example here, just very briefly, if you imagine a bell-shaped curve like this, normally what will happen is when the iPhone started, we weren't very sure whether the iPhone is going to be hit or not. So it started to grow slowly. And now the sales are peaking up for iPhone at this level. Now, beyond a certain stage, people will grow, kind of very used to the iPhone, and any new products which are going to be launched will not generate much sales unless there is a drastic difference in the features. So what we get to see is all businesses and all products follow this particular cycle. And this is very true for a particular economy as well, which is like the UK. So here, what we get to see is basically, within the economy, you will get to see what you call cyclical movements in the bell-shaped curve, which allow the economy to grow, contract, expand, and in some cases, when we had recession, the financial crisis that we had a couple of years back actually led to a bit of recession in the economy. Now, how does budget deficit influence business cycle? Now, when budgets are being planned, two things can occur. That means either the taxes can rise, which could mean that the businesses would become more restrictive in terms of their pricing and their strategies to expand. And the other thing would be it also affects business confidence. Now, let's look at this as an example. Have you ever looked at, have you noticed the Bank of England news briefings when the Governor of England actually does a news briefing in terms of forecasting and giving out some press briefing when at the beginning of every quarter? Have you seen that?
Not quite, no. I've seen some news about like when HBOS started to struggle.
Yes.
And then they had to get bought out by Lloyd's.
Yes. Absolutely correct. But say, for example, if the previous governor of Bank of England was Mervyn King. Now, when he used to do, quarterly updates with the press in terms of how's the inflation rate, how's the exchange rate between the pound and the dollar, and in general how the market. So what they do is the Bank of England actually gives out forecasts, and these forecasts kind of affect how businesses plan their budgets, the requirements in terms of financial requirements, and also it gives out some sort of an outlook in terms of how the economy would actually be faring across the 4 quarters. So Jan, Feb, March, April, May, June. So you look at summer, spring, autumn, and winter. Now these kind of predictions and forecasting which happens have an effect on the direct effect, an indirect effect, not direct, indirect effect on the business cycle. Now, what businesses do is, because of the Brexit, as you know, a lot of businesses have become restrictive in terms of making investments, because they aren't very sure in terms of how and what is the government policy, whether it is going to be a soft Brexit or hard Brexit, whether we'll remain in the European Union, have the access to the EU market, or will we trade only through the WTO, which is World Trade Organization. Are you aware of these things?
Not these things, no.
Right, okay. So in general, what I'm trying to explain here is that when you look at the market sentiment, there are lots of factors which can affect how markets go. So say how the FTSE actually does on a daily basis, or how the when you look at the stock exchange actually does. So they look at some of these news which comes out from the government and also from the Bank of England, the Governor of Bank of England. What they look at is they see these as indirect influencers, because they then tend to read into this to be able to see how the market will move. And it involves a bit of forecasting. And that forecasting is nothing but businesses planning their business cycle in terms of how they will run and manage their finances every month, every quarter, and for the year. And this creates what you call cycles, which actually helps the financial departments within businesses to plan their working capital or cash flows, or how much inventory will they have on products and services. A good example that I will give you, I think you should be able to relate to this, would be when you look at the festive season, the Christmas period, when it starts to come. Most of the companies, they start to become quite bullish, and they start investing and looking at new stock, or stocking up the stores, because they know, because of this particular festive period which is coming, the sales are generally going to rise. People are going to go out and spend. Have you seen that?
Yes.
And then once the Christmas and the New Year is over, we normally see a slump. That means the figures in terms of sales actually go down slightly when we look at the months of January and February, because people are kind of saving in to pay off the credit card bills and basically the excess spending that they've done during that kind of the special festive period. So that is basically an example of how businesses plan when they know that, for example, when the Easter vacation is coming next month, a lot of holiday companies have started to advertise already, because they know a lot of us will go out and go out for a short break with the family during those holidays. So what they tend to do is they plan their activities in a cycle which then kind of regulates the growth in economy, or it regulates kind of the demand and supply in the economy for those particular products. Is that understood?
Yes.
So if you look at January, February, there are not many very companies advertising holidays. But come Easter and come just before the summer break, a lot of companies you will see start to advertise, because people then start to look at the options wherein they will go in for a holiday. And that tends to form some sort of a cycle. So all the holiday companies clearly know that these are the key points in the year when actually people will take out a vacation or buy a vacation or a package. Are you with me on that?
Yeah.
Okay. Now let's look at some of the advantages and disadvantages of budget deficit. Now, if you look at what is a deficit?
Budget deficit is
Yeah.
when.
What is a deficit? What is a deficit?
Deficit is when.
Yeah.
Well, it's a minus basically.
That is correct. So in short,
Yeah.
you're correct. Budget deficit is, that means we are spending more than what we are earning. So the deficit, benefits of potential deficit in those cases are that sometimes if the government is spending more than what it is earning, then it leads to more investment in the infrastructure, or more initiatives which the government is able to take to be able to grow the economy. So in the last couple of years, when we are coming out of recession because of the financial crisis of 2007 to 2012, the government has been borrowing more to stimulate growth in the economy. And this is being done by making sure cheap money is available through the Bank of England. There was a concept which Mervyn King invented called quantitative easing. That means the government is buying a lot of bad debts and bonds from the bank, which are being refinanced for a number of years, like 10 years, 15 years, and the money is being made available to be able to stimulate growth in the economy. And this is nothing but the potential benefits of budget deficit. So it is trying to create a positive impact on the macro environment in general is the bigger environment, so that it stimulates demand, and it stimulates businesses to invest and consumers to spend, because there is cheap money, or money available at lower interest rates in general in the market. Now, apart from that, what we look at is this particular instrument. When we say budget deficit, becomes an instrument because the government then tries to borrow more money and invest more money in the economy to be able to create growth, jobs, and obviously, more long-term sustainable growth. And this in turn leads to a stimulus which allows a general feel-good factor, wherein the businesses also then, because the money is available, the interest rates are low, the inflation is low, and money is available in general from the Bank of England. What they tend to do is they tend to make more investments, which means to grow the business and to take on more employees and create more jobs. So these are some of the potential benefits of when we look at the fiscal policy. It creates budget deficit or a budget surplus, and that is an instrument which the government actually uses to stimulate growth in the economy. And growth in the economy leads to the market sentiment being bullish, which means that the businesses invest more in terms of creation of job, or in expansion, globalization, it could be that. And that basically then tends to in general create jobs and well-being within a particular country or economy. Now let's look at some of the key things on the other side, which is the monetary policy. Now the monetary policy will have a couple of things in it, which basically would mean that the government tries to use the monetary policy as an instrument to regulate the interest rates, the bank interest rates, the exchange rates. Have you heard of something called LIBOR, London Interbanking Exchange Rate?
No.
No. Okay.
No.
There was a scandal a couple of months back wherein a lot of banks like Barclays, RBS, HSBC were fined by the Financial Conduct Authority and also by the US authorities, because the banks between them had a very preferential way of setting rates for borrowing, and the actual rate at which the Bank of England was giving money to these banks was not being passed on to the consumers. Now, what during the financial crisis the Bank of England has done is it has used an instrument called quantitative easing. That means it has bought back a lot of bad debts, or bad debts, let's put it this way, bad debts from the bank and bad assets of the bank, to be able to then own it and say, okay, against these assets, we underwrite these bad debts for the bank of, say, an example, Royal Bank of Scotland. And that created a consumer confidence and market confidence in general. Now, the Bank of England has kept the interest rates at record low levels. Now, when they give money to the banks at 0.25% in terms of borrowing, that rate does not effectively translate to an interest rate at which you borrow from the bank. So if you take out a personal loan today, or if you take out a loan today from the bank, your minimum interest rate would be 2.5 or 3%. So this mechanism through which it is able to give cheap money at a cheaper rate to the bank, and then the banks can charge and make some money by increasing the rate and then give it to the consumers, but in between make that cut, is something called the interbank lending rate. And there was a scandal because of which the monetary policy, the Financial Conduct Authority, which is one of the regulators, actually detected a fraud, that the banks are able to exchange money or lend money to each other at a cheaper rate, but when it comes to giving the same money in the form of a loan or to a customer, or long-term working capital borrowing costs for a company or a business, that rate being charged by the banks is too high. So monetary policy actually deals with all these laws and legislation in short. And I'll send you a bit of a handout for you to read, to obviously increase your know-how and also to look at understanding in this in a bit more detail. Now, monetary policy will include things like interest rate, exchange rate, which is when you go to, say, for example, for holidays to say Paris, you would want to buy dollars, so you will exchange pound against the dollar, and the exchange rate is something which varies in terms of what basically is the market going rate in terms of borrowings between the European Bank and the Bank of England, the European Central Bank, ECB, and the Bank of England, and that kind of regulates what is called the exchange rate of currency. The monetary policy also affects the availability of credit. So if the interest rates begins to rise, there will be less and less money which will be available, with the banks to be able to lend to consumers and businesses, because businesses would not want to borrow money at a higher interest rate. That means it will become non-profitable for them to be borrowing the money and then not getting the return on investment, and then paying back the interest and principal back to the bank. So what is the effect of, why do we have monetary policy? The monetary policy actually looks at creating a balance between demand and supply, or the output. So it is a very key factor which actually regulates the demand and supply for most manufacturing businesses in the UK. And it creates something called inflationary or deflationary pressures in terms of price points in the economy. Do you know what is the inflation rate at this moment in the UK economy?
No.
Okay. I think, to the best of my knowledge, it's 1.8% as of now, which is the inflation rate. That means if you earn say, for example, if you earn £100, there is, when you look at the actual value of money, the actual value of money is actually 98.2. That means £98 and 20 penny, because there is inflation in the market. And this is something which is a monetary instrument which the government uses. Now, the Bank of England's target rate for maintaining inflation is 2%. So if prices of certain products increase and you do not get a wage increase in your salary or your wages, what will tend to happen is that you are actually earning less than what the affordability is in the market. Do you understand this? Yeah. So if I'm, say, for example, earning £100, but my living expenses are £102, that means there is a high amount of inflation, which means either I'm underpaid, or in this case, the value of the money does not stand the true test in terms of its valuation in the market. Okay, let's look at very briefly just in the interest rates and how does it affect the economy. Now, as you understand, if you have a 1% interest rate and you borrow £100, you have to repay back £101, and that interest rate is monthly. So if it's calculated on an annual basis, that means on that £100 you're actually returning 101, so it's £1 per month, so it's £112 that you have to return. So the cost of borrowing from the bank in general actually is directly proportional to what is called the interest rate. Now, there is something which is again a term which you normally get to hear in news quite often, that there is no incentive for savers nowadays. Can you relate to this term? No. Okay. The reason why they say is because the interest rate is so low that if you keep your savings in the bank, you're actually earning nothing because the government is not trying to kind of incentivize people to save money now. If the interest rate in the bank, if you had, say, for example, say £10,000 and you would want to put in your savings account to get some interest and not use it and maybe use it for, save it for rainy days, the rate of interest for savers, when you look at normally banks, in the banks was between 5 to 7% in the early 90s, and that has kept falling. Today that
Yeah.
rate of interest is 0.25%. So what it means is that the government is not looking to incentivize people to save. If you save, the government is not interested. But if you're spending and borrowing, they are more interested because there is cheaper money available from banks or as credit on your credit cards and things like that. Now, this means in general, when you look at your disposable income, and if you are, say, for example, if you are looking at taking out a mortgage, that means it is cheaper for you to take out a mortgage right now rather than to save that money and then take out a larger mortgage later because you're not getting that much return on investment because of low interest rates. So this, thing, when you look at the larger economy, has a couple of, effects. One, it stimulates, as of now, there are certain schemes which the government has introduced, like the help to buy scheme for the first-time buyers of houses. So what the government is doing in that scheme is they are essentially giving you a part contribution to make a deposit to buy a house if you're a first-time buyer. This low interest rate actually is building up consumer confidence or boosting consumer confidence because with 5% of your own deposit, actually you can go out and buy a house by getting a mortgage. As against, if you look at a couple of years back, you needed to have minimum 15%, 20% deposit to be able to get a mortgage. Correct?
Yeah.
So these things, when you look at, yeah, sorry, go ahead.
10% was it?
10%, yeah. I think a couple of years back minimum was 10%. But yeah, if you're looking at buying properties beyond, say, 300, 400,000 pounds, they were asking you to have, maybe up to 20, 25%, capital with you. Or they were expecting that you could borrow up to 4.5 times your income. But before the recession hit us, we were also able to get mortgages which were 6 or 7 times our earning potential or our income. But that's now fallen to about 3% or 3 times your, income potential at this moment. So interest rates has these kind of effects when you look at, on the economy in general and in businesses in general. As the interest rate starts rising, the house pricing would start to, fall because the interest rates will become high. And what that would mean is less and less people will be able to get onto a mortgage and then get onto buying a house. So this is an instrument which the government uses under the monetary policy to be able to regulate demand and supply in certain sectors. In particular, when you look at the construction sector, because if people buy a house, you can understand that when you buy a new house, it leads to your actually going out to the market and spending in a variety of ways. You'll buy maybe something for your living room, your bedroom, you'll buy lots of things. So it stimulates house construction in general is a big industry within any economy, which actually stimulates all the other areas of economy in terms of growth. Right, brings us to the last few slides. Now, history of Bank of England, founded in 1694. It is the central bank as far as we are concerned. So the functions it includes is, obviously it issues currency or creates notes, and obviously all the other banks are regulated, and obviously the Hi, Phil. Welcome back.
Hello.
I think there was a slight bit of lag on the Wi-Fi, so that's the reason it got disconnected. But that's the last slide that I'm coming to. Is basically what I briefly explained is how over the years the monetary policy is actually shaped, and how the Bank of England and the Chancellor of the Exchequer actually look at reviewing this policy at the end of the year. So the Bank of England gets certain targets from the government and the Chancellor. For example, they need to look at having their interest rates at a level wherein it maintains inflation at 2% or below 2%. They need to look at that there is free flow of credit or liquidity in the market in terms of money flowing from the Bank of England to the other commercial banks for lending, which actually stimulates, spending in the market. Consumers get the money from the bank, are able to draw money from the bank. Do you recall that before the financial crisis, what was the amount of money which was underwritten by banks if the bank was to collapse, or underwritten by the government actually and the Bank of England if the bank was to collapse?
I don't recall that. I know that there was a deficit, and since the Tories or coalition government came into place in 2010, they've done a lot of job cuts and increased costs to pay back the deficit.
Yeah, that's correct. So if you recall, some of the banks like the Icelandic banks, which actually collapsed, the Irish banks, which actually collapsed in the crisis in 2007 and 8. What happened was a lot of people had invested a lot of money in these banks because these banks were paying high interest rates to savers. So if I had my savings, 50, 60,000 pounds or whatever, a lot of people had actually invested money, taken out the money from the banks in the UK and actually invested in the banks in Icelandic banks and Irish banks. And because their interest rates they were offering to people who were saving were 5, 6, 7, even 8% in some of the Icelandic banks. Now that kind of a return on investment was not even guaranteed if you had bought property or any other asset, and that did not appreciate by 8% on an annual basis. Now when these banks actually collapsed, there was a financial limit which is underwritten by the the Bank of England and the FSA at that point in time. It was Financial Services Authority. Was that if a consumer had up to 35,000 pounds in the bank and the bank collapsed, then that amount of money was liable to be paid by the government or the Bank of England to the consumer. Now that was the limit, which was essentially the initial limit. But after the financial crisis, because a lot of people in terms of pension funds, for example, a lot of companies which are government departments, councils, which had put money in these banks in particular, because the rate of interest at which they were earning returns was much higher than the banks providing that in the UK. The councils, I think, if you were, I'm saying if you were kind of looking at the news or hearing the news and tuned in, maybe some of these things are, in our lifetime that we have seen this kind of a financial crisis. A lot of councils like the Surrey Council, West Yorkshire Council, they actually went bankrupt because they had invested millions and millions of pounds in these banks. Now, the amount of money in the case of commercial banks, commercial investment is guaranteed to a certain extent, but for personal savers, it was 35,000. So a lot of people which had pensions and had invested money in these banks actually lost out because the banks did not return that money. Their limit set by Financial Services Authority, FSA, was up to 35,000. After these crises, the Bank of England has actually raised that threshold to 75,000. So if you have up to 75,000 in a bank, and that bank is, say, Northern Rock, for example, when it collapsed. So if any of the bank today collapses, if you have up to 75,000 pounds in that bank, that money is guaranteed to be repaid back to you by the Financial Conduct Authority. Is that okay?
Yes.
Now that threshold was raised, and that is where obviously the evolution of monetary policy, the last slide which I'm trying to explain is that over the years, because of the financial crisis, the Bank of England and the Chancellor have actually rewritten the monetary policy. That is why it is called the evolution or evaluation that we would basically do, is because of the changes and the circumstances which were created because of the financial crisis. Some of these things had to be relooked because a lot of people lost money. A lot of savers, old people, pensioners actually lost money because of the financial crisis. Is that okay?
Yeah.
So what we've today covered, in particular, is learning outcome 2 in the context of this unit business environment. And what I'm going to do is obviously send this slide to you, which will give you an overview of what we have covered. But along with that, what I'm going to send you some handouts, which is fiscal policy, monetary policy, exchange rate, inflation. And these are things which will also give you a detailed overview and obviously a know-how in terms of how these instruments are actually used by the government and the businesses, and how they have a long-term effect in terms of demand and supply, in terms of an economy, and how they affect the business cycle.
Okay.
Is that okay?
Yeah.
Good stuff. Thanks for obviously bearing with me today. Keeping in mind I had to change the timings because of some marking at my end, and I will catch up with you in terms of the regular timings next week.
Yeah,
and I'll
right.
send this email to you, for both the units, financial decision-making managers, and also for this, so that you have that as a reading material for the next for the next week, essentially.
Okay.
Okay.
Thanks
Okay.
a lot.
Thanks, Phil.